Good morning. We will pay attention to asset disposal, fixed assets, and VAT today. When we do asset disposal, we must work very systematically to do the 5 steps that's required on the date of the disposal. Step number 1 is to calculate the depreciation for the current year. Normally, we only calculate depreciation at the end of the year. So if we use the asset for 2 or 3 months in the current year, we first have to get the information of the asset up to date so that we have all the accumulated depreciation from the date that it's purchased until the date the asset is sold. So my step number 1 will be to calculate depreciation on this asset sold for the number of months that we used it in the current year. Step number 2 is to transfer the cost price of the asset to asset disposal, because if we dispose of the asset, we can't keep the asset in our books anymore, so we have to reduce the amount in our vehicles account. The cost price, so the vehicles account and the accumulated depreciation account actually form a unit. The cost price is my positive asset, vehicles. Accumulated depreciation is my negative asset. Therefore, it means that if I remove the asset from my books, I must also transfer the accumulated depreciation from the date the asset was purchased until the asset is sold to the asset disposal account. Then we will record the proceeds. How much money do we get for the asset? That means we've put all the information about this asset in the asset disposal account now. We transferred the cost price, transferred accumulated depreciation so that we know what is the carrying value. We record the proceeds in that account. So in this asset disposal account, I can determine whether we made a profit or a loss on the disposal of the asset. This is the 5 steps that we will do on the date that we dispose of the asset. Then we must remember that at the end of the financial year, we have to calculate depreciation on the assets that we still have in our possession. So that means assets that we bought in previous years. So we had those assets at the beginning of the year. We still have them. We haven't sold them. We will calculate depreciation for 12 months. On new assets that we purchased during the current financial year, we will calculate depreciation for the number of months that we use this asset in the current year. It's very important to determine when is the end of the financial year, 30 June, and that we must determine whether the VAT was included or excluded in the purchase or sales amounts. When we look at the asset register, we see that the asset cost price was 303012. That included the VAT. We can never include VAT in our vehicles account because the VAT is going back from SARS. That means that it's not part of the cost price. Depreciation will always be calculated on the cost price excluding the VAT. So the first calculation that we will have to do is to complete the calculation to determine what is the cost price of the old vehicle excluding the VAT. Cost excluding VAT is 100%. Cost including VAT is 114%. This was given to us. So if we want to know what is the cost excluding the VAT, we will take the amount, multiply with the percentage that we want to know, divide by the percentage that we know, and that will give us the cost price of our vehicle. This is the amount that will be recorded in our vehicle account and this is the amount that we will use to calculate depreciation. We will start our vehicle account with this amount, excluding the VAT. Vehicle is an asset. Assets is 100% accounts because we are not allowed to include the VAT in the asset because we claim the VAT back from SARS, so it's not part of the cost price. Assets increase on the debit side and decrease on the credit side. The next calculation that we will have to do is to determine the depreciation on this asset. Now, we purchased this asset on the 31st of January 2014. Remember that the end of the financial year is 30 June. So you don't work out the depreciation on the birthday of the asset. You work it out at the end of the financial year. So if we bought it on the 31st of January, we will only calculate depreciation from the 1st of February up to 30 June 2014, because that's the number of months that we used it in the current financial year in 2014. It's very important to determine the percentage and to see if it's calculated on cost or diminishing balance. We bought the vehicle on the 31st of January. That means we didn't write off depreciation in January. We will start writing off depreciation from the 1st of February up to the end of the financial year on the cost price, excluding VAT, times 15%, and now we calculate how many months is that. So it's January, no depreciation because we bought it at the end of the month. We will only write off depreciation for February, March, April, May, June. That means for 5 months. Then the next year we will work it out from the 1st of July up to the last day of the financial year, and we will use the cost price less the accumulated depreciation that we calculated the previous year. Calculate 15%. We used it for the full year, so that gives me 37,378. So that means that is the end of the previous financial year. So these two amounts were already written off in previous years. In the current year, because we are selling the asset, we will start writing off depreciation from the 1st of July. We are selling it on the 31st of January. So we take the cost price, less the accumulated depreciation of the first year, less the depreciation of the second year, work out 15%, and we determine how many months. So it's July, August, September, October, November, December, January, 7 months, and that is my step number 1. So remember, step number 1, we have to calculate depreciation for the current year. When we get to step number 3, we need the total depreciation from the purchase date to the date that we've sold it. So we will add the 3 depreciations to see that the total depreciation is 72524. If I subtract that from the cost price, I work out what is my carrying amount. So cost less accumulated depreciation gives me the carrying amount. We can now determine whether we made a profit or a loss. My carrying amount, so what it's worth on the date that we sell it, is 193276. If we sell it for more than that amount, we make a profit. If we sell it for less than that amount, we make a loss. So we made a loss, if we subtract the two from each other, of 13,276. In your accumulated depreciation account, you will have the 2 amounts for the previous years that you've already written off. Then my step number 1 is I will credit accumulated depreciation to increase the accumulated depreciation so that we know what is the total amount. We will write the word depreciation to indicate that the double entry is recorded in the depreciation account. The depreciation account will be debited on the date that we sell it, and we credited accumulated depreciation. Depreciation is an expense. Expenses increase on the debit side and decrease on the credit side. So step 1 of asset disposal is to debit depreciation, credit accumulated depreciation, so that we know what is the total depreciation from the date of purchase until the date that the asset is sold. Step number 2 is to remove the asset out of my vehicles account. So I will credit my vehicles account to reduce the asset, and I will transfer it to the asset disposal account to complete my double entry. The word vehicles will be written there to show that the double entry was in the vehicles account. Thirdly, we will do the total accumulated depreciation and take it out of my accumulated depreciation account and transfer it to my asset disposal account. So it means that I will take all the depreciation from the purchase date until the sales date, and that total amount will be transferred to asset disposal. Step 4 is to determine what is the sales price of this vehicle excluding the VAT. They told us the sales price excluding VAT is 180,000. So they gave us the amount excluding VAT. When we record the sales, we have to show that we sell the goods and that we claim VAT on behalf of SARS. So it means that we have to calculate the VAT. So the one that I want, 14, divided by the one that I know, 100, will give me 25,200. And I will show that the total sales price, including the VAT, is 114 divided by the 100 that we know, and that will give me 205,200. My debtors control account is an asset that will increase on the debit side and decrease on the credit side. So I will increase my debtor with the total amount including the VAT. The 180,000 excluding the VAT will go to the asset disposal account. The 25,200 that we collected as VAT on behalf of SARS will be transferred to the VAT output account. VAT output is a liability that will increase on the credit side and decrease on the debit side. So the VAT output is credited to indicate that we collected money on behalf of SARS and that we owe this money to them. The sales price excluding the VAT will be recorded in the asset disposal account. So we've recorded step 1 now, calculating depreciation for the current year on the assets sold. Step 2, we transferred the cost price to asset disposal. Step 3, we transferred the accumulated depreciation to asset disposal. Step 4, we recorded the sales price. And step 5, we can calculate now whether we made a profit or a loss. So we will balance our asset disposal account, and that will give us the loss that we made of 13,276. And that will be recorded on the debit side of the loss on sale of asset account. So we've done all 5 the steps of asset disposal now. And the next step that we will do is to record the purchase of the new vehicle. The new vehicle purchase, They gave us the price including the VAT, so they gave us the 114% amount. So if we want to know what is the amount excluding the VAT, the one that we want over the one that we know, and that will give us a cost price of 260,000. The VAT amount will be the one that we want over the one that we know, 114, and that will give us 36,400. So we can claim this 36,400 back from SARS. We bought a new vehicle on credit, so we will increase our creditors on the credit side with the cost price of the vehicle and the VAT input. VAT input will be debited with the amount that we can claim back from SARS. The vehicle account will be debited with the amount of the cost price of the vehicle excluding the VAT, indicating that the creditors control account was credited with this amount. Now we are at the end of the year and we have to calculate depreciation at the end of the year. Depreciation is always calculated on the cost price excluding the VAT, because the VAT doesn't belong to the business. We claim that back from SARS. So it means this new vehicle we bought on the 1st of March, the end of the financial year is 30 June. We will calculate 15%, March, April, May, June, 4 months, and that will give me 13,000 rand. The accumulated depreciation account will be credited with 13,000 and we will debit depreciation with 13,000. In the depreciation account, we will show that accumulated depreciation was credited with the 13,000. At the end of the financial year, all the B accounts, assets and liabilities will be balanced so that we can take the balances to our balance sheet. The VAT input and VAT output will be transferred to the VAT control account, and all the nominal accounts will be closed off to the profit and loss account. VAT input has a debit balance, so we close it off crediting VAT input, and then we will debit VAT control. VAT output has a credit balance, so we close it off debiting VAT output, and we will credit VAT control. Which GAAP principle is applicable when the selling of assets? The historical costs concept, because the price that we originally paid for the asset will be removed from our books. Why must VAT be calculated when selling the vehicle? When we purchase the vehicle, we claim VAT back from SARS. So if we sell the vehicle, we have to pay VAT to SARS. And the owner needs to pay this VAT that they collect on behalf of SARS to SARS at the end of the month. So it doesn't matter whether you sell goods or you render a service or you sell assets. Anything that's sold that provides an income to the business, you will have to calculate VAT on it and pay it over to SARS. What is the implication if they decide not to calculate the VAT? It is against the law. A business registered as a VAT vendor must collect VAT on any income on behalf of SARS and must pay this over to SARS. This will be unethical behavior and you could be fined or be prosecuted.